All right, today's an exciting video because I'm going to share with you the third investment hack that you've probably never heard of. The first two most people know about, and if you're able to, you're probably already using. The first would be investing with fractional shares. Before fractional shares, it was very hard to make sure that all the money that you wanted to invest could be active in the market at the same time. You had to save up for those pricey stocks, to save up enough to buy another share of, let's say, Amazon or Google. But with fractional shares, you can have all your money working for you all the time. The second is zero commission trading fees. So in the beginning, with Robinhood and some others, it was a new thing, but now most American brokerages offer zero trading commission fees. And so you're probably already using those two. If you're not, it's just a matter of choosing a brokerage account that will allow you to have an account where they offer those two things. And there are plenty of choices out there. This third investment hack is a little more specific to each individual investor, but I call it hijacking your retirement account. Now, you've probably never heard it spoken about like this because I watch all kinds of financial YouTubers, all kinds of stock investment YouTubers, and I've never, ever heard someone talk about using it quite like this. And if you use it, you will probably get more benefit from this than the other two hacks that everyone's able to use nowadays. So you're probably wondering, why would I call it hijacking your retirement account? I think you'll understand why by the end of this video. But I can't begin simply by jumping straight to the end. I have to set it up by talking about how your current retirement account is probably working for you. Okay, so the first account that we're going to talk about is the retirement account that you get from your job. And so this is usually offered as a benefit that your job will allow you to withdraw money from each paycheck, and it's going to contribute towards a 401k, an employee stock option plan, or some other kind of retirement vehicle. They offer this as a benefit to you to encourage you to start saving for your retirement. But they're going to allow you to withdraw directly from your paycheck. It's either going to be a set dollar amount that you choose or a percentage, and it's going to go directly to your retirement. If it's set up like a traditional retirement account, like a traditional IRA or a traditional 401k, it's going to bypass the taxation part. You're going to contribute that money before the taxes are taken out. And so that makes your paycheck look a little bit smaller for tax purposes, which means you're going to save on the taxes today, right now, this year. So when you do this, you're going to end up dollar cost averaging. That's adding the same amount or a very similar amount, same percentage, out of each check every week, every 2 weeks, every month, depending on how often you get paid. Then you're also going to save on the taxes now, and you're going to have your investments in that fund protected from any tax events happening while you save for retirement. Okay, and then the idea with this account is your money, your investment is shielded from taxes all the way until you get to retirement. And then once you retire, when you're making distributions out of that fund to fund your retirement, then you pay taxes on it. Now, another benefit that many people enjoy is if it is a 401k, your limit, your maximum amount that you can contribute may be a lot higher than if you're doing a traditional IRA account. So let's talk about a traditional IRA account for just a moment. So the traditional IRA is very similar to all those things I just said right there, but it can be set up by an individual. Maybe you're self-employed, maybe you work for a company that doesn't have a structured plan like this. You can do that on your own. It needs to be a registered retirement account, but the maximum, if you're doing it by yourself, if you're under the age of 50, your maximum contribution at this point is $6,000. If you're over 50, you can add an extra $1,000 to that. But one of the benefits that you may enjoy if you're in a 401k or an ESOP or something like that is the maximum may be much higher. So you may be talking about up to around $20,000 a year that you could put in that kind of account that's tax shielded. If you have more money, then you can contribute to your 401k. If the cap is lower and you would like to contribute more, you probably want to talk to a financial advisor or a CPA, a certified public accountant, and find out if you qualify to also have your own IRA that you can also add money to on the side. Now, as we're talking about these things, you're probably thinking these are all good things, Jeff. These are all positive. You're saving for retirement. These all sound like positive things. Why are you making this video? Okay, I want to pause right here and ask you, if your fund is set up through your employer, I want to ask you if you know the answer to these questions. Number one, what are my investment options? Do I have to pick a mutual fund? How many different mutual funds do I get to pick from? Or can I pick indexes that usually have lower fees attached to them? And which indexes are my choices? Can I invest in cryptocurrency? Can I invest in company stock? What are the terms with the company stock? What are my choices of how I use this money? Number two, what is the maximum that I can contribute each year? Number three, what is the maximum amount that my company will match? In most cases, a 401k is set up with the idea that the company is going to match a portion of what you contribute. Often it's 1-to-1 up to a certain limit, meaning if I contribute $1,000, my company will also match that with $1,000. In some cases, they will do a 50% match. And so if I contribute $1,000, they would put in $500 as far as the match. So what is the max free money contribution max that I can get from the company, and what are the terms? And finally, this is the hard one, what are the fees? Okay, what fees will I be charged when I'm using this account? Now, if you were going to go out and shop for a financial advisor, you would want to know, how am I paying you? Is it a percentage off the performance of my portfolio? Is there a set fee? Is there an hourly rate? If you're investing in anything, you should want to know what fees are attached. Now, the tough thing is when you do this at work, the people at work usually won't have good answers for you. Go in expecting them not to know how to answer that question, or even to just say, I don't think there are any fees. You see, owners and managers usually understand enough about the fund to try and market it as a benefit to you, the employee. They believe in it, they feel like it's a good thing for you, and they're not worried about answering every little detailed question. Maybe they've never asked, and maybe they've never seen the answer. Now, when you're looking for this answer, don't settle. Don't settle for a verbal answer, and be prepared to do some digging. You want to know, who do you have to go to find the real answers? Who do I have to talk to? Who do I have to call? Which website do I have to go access? Because the answers for the fees may be hard to find, but you deserve to know what fees are being taken out of your fund. These fees could be a straight dollar amount that's taken out every time a transfer is made. So if you get paid weekly or bi-weekly, think about every time a small fee is being taken out. Or they could be quarterly fees or just annual fees for maintaining your account. Also, within the investment itself, is this a mutual fund? What is the fee attached to that mutual fund or an index fund? You should be able to see which fees are going to pay who. Okay, just to touch on it real quick, you may be thinking about a Roth. Maybe you have a Roth IRA. Okay, if you've got a Roth IRA, it operates very similar to a traditional IRA with the same maximum, and you set it up on the side and you control it. But when you do that, what you're doing is you're paying the tax on that income now. You're contributing that money post-tax. And then the benefit to doing that is that you never pay taxes on that in the future as long as you leave that in your fund until retirement. And when you're getting the distributions in retirement, that money is still tax-free, and that's fantastic. It operates similar to a traditional IRA, but you're handling the taxes now instead of later. Okay, so if you're listening to this and you're thinking, I have like 4 different retirement accounts from different jobs that I've had in the past. I have a 401k, an IRA, a Roth IRA, or maybe you're listening to it and you're saying, I don't have anything. I haven't even started yet. I don't know what to sign up for. That's okay. In any case, it's important to understand how these things usually work so that you can choose what's going to work best for you. And we're going to get to that whole hijacking thing in just a minute. Okay, so we're taught by our parents, our teachers, our employers, our mentors, everybody in society saying, do this right here. Why? Because you don't want to get to retirement and not have put away money. And so the job is going to help you by picking the retirement vehicle for you. And all you have to do is fill out a little form, say, take 10% of my paycheck or take a certain amount of money out of my paycheck. And you could be dumb and lazy and just sock that money away. Just put that there. That's your safe money, and you're just going to sock it away for the next 20, 30, 40 years. And when you get to retirement, you're going to be fine. Okay, over time, what's going to happen is at some point, you're probably going to realize that you're not getting enough money into this account, or you're going to be in the fortunate circumstance where you say, I've maxed out how much I can contribute here, and I'm just going to start another account on the side. And this is going to be a regular money investment account. Okay, now if you start a regular money account, what's going to happen is usually we consider this our safe money. Don't touch it. Just put it away. Forget about it. Just let it come out of your paycheck and don't touch it. Don't touch it. Just dollar cost average, buy and hold, never sell, ever, ever, ever. And then when we start a regular money account, what happens? We usually only add funds to the regular money account as we have them. It might be not as consistent, and this is usually a smaller amount. And then we end up saying, you know what, this is my risky fund. So when I go and put money in this fund, if something happens to it, maybe I don't feel as emotionally bad about that. I feel okay with it because this is just my risky account, my extra account. Okay, so what happens in this account is usually I'm going to use this account for trades as I learn to make moves in the market. As I learn about investing, I'm going to want to try options. So I'll use this account because you usually can't do anything like options in these other safe accounts. So I'm going to use that there because this is my risky small portfolio. Okay? If you're ever going to use margin, it's going to be in this account. Why? Because it's illegal to do it in your IRA retirement account. The IRS will not let you do it. So if you're going to use margin, it's going to be in this account. So if you're not careful, this turns into your YOLO fund and anything goes in this fund. Now here's my question for you. If you had equal amounts of money, I know you probably don't, but let's say you had equal amounts of money in this account and this account. Which one can you make moves in and not have to worry about the tax consequences? Yeah, that one. So why in the world do we end up doing all that stuff in this account? Now, if you follow my channel over time, I'm going to share with you that I've had really nice returns, market-beating returns, without any of this, and without any of this, and without any of this. Okay? I do trade, meaning 2 weeks, 2 months, a year. I do make trades in and out of stocks all the time, but I don't do the crazy stuff, the super risky stuff. So what I'm advocating in hack number 3, hijacking your retirement account, is saying, what if we flip the script and we do our safe dollar cost averaging, park it in an index fund and don't touch it? We do that in our regular money account, and we do the trades, the buying and selling depending on the situation, in our safe fund. Now, you're probably going to tell me, but Jeff, I can't do that in the 401k or in the employee stock option plan fund that I have at work. And that's why I would ask you to consider moving to an IRA. If you have a situation where you have old 401ks, old IRAs, you can roll them into a self-directed IRA fund that you control, and you can take charge of your investments even for retirement. If you're currently at a job where you have a retirement account, that one is kind of stuck. You can't roll that one out of that fund until you leave that job. And maybe you're happy at that job and you stay in it for the rest of your career. That's fine, but you want to get as much capital under your control as you can. And so depending on the answers that you found out when you asked those questions earlier on about the fund that you have at work, like the fees and the maximums and the amount that they're going to match, you may decide, like I did, that it's time to get rid of the 401k fund. In my case, my maximum amount that the company was matching was $750 a year. Now, I was contributing a lot more than that. I was contributing almost $6,000 a year. But when I found out about the fees, it suddenly made sense why my fund didn't seem to grow any more than the contributions I was making. And that's because the fees upon fees upon fees that were hidden within the mutual fund and the transaction amounts were eating up almost all of the match. So what I decided as soon as I realized that was I figured out that if I reduced my contribution out of my paycheck to $14.50, that would get me to that $750 a year, that I would get that free money from the company, and I was maximizing that free match, and the fees associated with that would be much smaller. And then I would take all the rest of the money that I was already contributing out of my paycheck, and I would fund it to a self-directed IRA. Now, if you don't have one of those, M1 Finance was the one that I found. Back when I was looking, it was the only platform that had all three of those hacks available: fractional shares, $0 trade commissions, and retirement accounts available. Now, I understand there are a lot of other platforms out there now that offer those. All I know is my experience with M1 has been very good. And so if you're looking, I would say consider M1 Finance. If you'd like to take a look at them, there will be a link in the description below that if you use that link and you decide to join, I believe the deal right now is a free $50 for you and a free $50 for me. And I'd really appreciate it. Now, just like every financial YouTube video you will ever watch or have ever watched, don't just take my advice. My thoughts in this video are to spur you to find out for yourself what's the right strategy for you, what are the right things to look for, and what are the ideas that may help you maximize your investment. In some cases, you may need to talk to a qualified professional. You may need to do a lot of digging and research on your own to decide if this plan will help you. I had a lot more I wanted to say in this video, but I don't want to make it overwhelming. But get thinking about this strategy. You owe it to yourself to find out exactly what you're able to do to maximize the money you have saved for retirement. I hope this video was helpful, and I hope you have a great day.